All right, so I'm still getting my voice back from this weekend, but I want to make sure I recorded one of these videos for you, just to kind of give you an update on things. So, really, what this is what's happening, what it all means for you, and what to actually do with it. So, Freddie Mac's weekly survey as of February 5th has an average 30-year fixed rate at 6.11% and the 15-year fixed at 5.5%. Now, the bigger story to all of this is that rates have been hovering near 6% and not swinging all over the place. When rates calm down, people can actually plan instead of feeling like they're buying a home on a trampoline. Now, remember, Freddie Mac is a national average, so your exact rate depends on your credit, your down payment, the loan type, and a few other real life details like where you live. The big housing headline that's going on right now and what it is and why it matters is that builders are sitting on a big pile of unsold homes and the biggest surplus in about 15 years, and that they've been pushing the White House for policy help to help move that inventory. Now, why this impacts buyers and sellers? Well, when builders have more homes sitting, they usually don't just stare at them and hope they can sell. They actually tend to get way more aggressive with their incentives, with things like rate buy downs, which is lowering the buyer's payment, closing cost help, and sometimes price reductions or even upgrades. So, how does this affect the whole market? Now, this can pull in some buyers towards new construction, which can then cool competition in resale, or it can put pressure on resale prices in certain areas if buyers have more choices. Now, on the rate side, the New York Fed's consumer survey just showed near-term inflation expectations cooling in January, a one-year expectation that dipped from 3.1 all the way from 3.4. So it seems small, but that's actually a pretty big dip. So why does this matter? Now, if people expect inflation to cool, markets often feel less pressure for rates to jump. If it doesn't mean mortgage rates drop tomorrow morning, well, then it's just one of the ingredients that helps keeps rates from getting spicy for no reason. Now, naturally, there's a wild card coming up because this week is also heavy on jobs and inflation data, and those reports can move rates pretty quickly because investors react in real time. Now, if the US data comes in weaker than expected, markets often then price in more Fed rate cuts in the future. And if it comes in hot, the rates can actually pop upward. And all of this is obviously based on the 10-year Treasury. Bottom line, this market rewards people who have a plan more than people who wait for the perfect headline. If you're thinking about buying or selling or refinancing this year, feel free to give me a call, DM me, or send me an email. I'm happy to run any numbers, pressure test some payments, and map out a game plan for you. Got questions? Let me know.